Welcome back to another episode of Equity Mates, a podcast where we explore what's possible in the world of investing. If you've just joined us for the very first time, a massive welcome to our community. We have a cracking episode for you to get stuck into today. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you going?
I'm good, Bryce. Very excited for this episode. As always, people get sick of me saying I'm excited, but how could you not be? Another big episode of Equity Mates. We are covering the news that is moving markets. Two big stories we want to cover off. Then we're going to be joined by Luke Laretive for a Pimp My Portfolio episode. And then finally, we're going to hear a little bit about what's on your watch list.
Yeah.
Not in your 500 to 5,000 quest,
no.
but more longer term quality companies.
Yes.
Big episode.
Yeah, massive episode. Let's get stuck in.
News and markets.
Now, Bryce, we've got two big stories we want to cover in the news today. We want to ask the question, has Netflix won the streaming wars?
Yeah.
And then we're going to talk about what's happening with work from home and offices. But before those two big stories, you saw the Superbowl last week, I assume?
Yes, bits of it. I didn't actually, I mainly saw the halftime show, to be honest.
Okay.
Yeah, I didn't really watch the game.
Fair enough.
Yeah.
It was a pretty disappointing game. The Philadelphia Eagles won, though.
Yep.
First Australian to ever win a Super Bowl, Jordan
Yes.
Mailata.
Yeah,
Love
yeah.
that. But this is related to the stock market.
Okay.
I got bad news for you.
What's that?
When a Philly sports team wins everything,
Everything.
wins the Super Bowl in the NFL or a World Series in the
Okay.
baseball, it's bad news for the stock market.
Okay.
So let me tell you the history, and you tell me
Oh my
what you think. So before the current Philly baseball team, it was the Philadelphia Athletics. 1910 they won. There was a 25% bear market. 1911 they won. All 12 months were in recession. 1913 they won. There was another recession in the US. 1929 they won. I don't need to tell you what happened in 1929.
Mm-hmm.
And 1930 they won, which was really when the Great Depression took hold. Then the Phillies, the World Series, they won in 1980, double dip recession in that year. 2008 they won, global financial crisis.
Yes.
And then 2018, the Philadelphia Eagles won a Super Bowl. It was stock's worst year since 2008. So with that history in mind, how are you feeling about the stock market now?
Well, I mean, last week we spoke about how many stocks are on there absolutely ripping. So that's all great coincidental stats. Doesn't change a single thing for me.
Okay, good to know. Well, I just want you to be informed because
Main thing is it's when the baseball teams get up. There's only one instance. There's only one instance of NFL, so I need more stats. I need more stats.
Well, look, speaking of the NFL and speaking of live sports, Netflix has gone hard into sports streaming this year. They've televised 2 live NFL games on their streaming service, and they also televised a fight with Jake Paul. And the reason we're talking about Netflix and the fights that they broadcast is because I think we can call the bigger fight. I think Netflix has won the streaming wars.
Yeah, definitely. I think, when did they, probably about a month ago or so, they released their quarterly and absolutely smashed it. I mean, they added 19 million customers, 302 million subscribers. They've raised their prices 16% and revenue was also up 16%. So it was like a stellar quarterly earnings report.
Yeah.
The strategy that they tried to implement, or that they did implement sort of 18, 24 months ago about that ad-supported pricing tier seems to be working well. So I think we can conclusively say they are the dominant streaming platform.
Well, to compare it, so Disney released their quarterly earnings. They also raised prices. They only raised prices 4%, but they lost 700,000 Disney Plus customers. They're probably second in line. They've got 125 million Disney Plus subscribers. But yeah, what we saw was that Disney Plus customers are more price sensitive than Netflix customers, I think is probably the thing to say. Probably third in line, HBO Max. Warner Brothers Discovery haven't released Q4 earnings yet, but we had a look at Q3. They were at 111 million subscribers, and the financials didn't look nearly as nice as Netflix. So you can say Netflix is, triple the size of its competitors. There's a couple of other interesting stats that I think just really show how much more dominant Netflix is than some of the other ones. So we had a look at churn rate, which is how often people are leaving the service. 2% of Netflix customers are leaving each year. It's pretty high compared to like a very sticky SaaS company.
Yeah, they're not a very sticky
I know,
SaaS company.
I know. Like, we'll put it this way: Xero's churn rate would be lower than that.
Of course.
Yeah. But how does that compare to Netflix's competitors?
Well, Disney sits at 5%, Apple at 8%, and Peacock at 9%. I get this. Like, as more competitors come on, you're constantly forced to choose between.
Yeah.
And I wonder if they then count for the customers that return, because we're very much like, for example, we just flicked on Apple at home to get through the 4S shows. You heard this?
What's 4S?
Shrinking,
Okay.
Silo, Severance,
Yeah.
and I'm going to have to leave you on a cliffhanger. I can't remember the fourth, but there's four good shows starting with S.
If you're listening on Spotify or watching on
what is
YouTube
it?
and you can leave a comment of the fourth show, because I am actually interested in knowing. Because I'm going to do that where you sign up for like 2 months,
Yeah, we just
bang
thought-
out the shows and then cancel
Yeah,
it.
exactly.
Yeah.
Stuff it, turn it on for a month, flick it off. But yeah, to have churn that low, for me, this is also like Netflix is just everywhere. It's on all the TVs that you buy now.
I mean, yeah, but so what? So you can, smart TVs, you can get anything.
yeah, but like a lot of them come with
Yeah, and like
Netflix.
some of the remotes have a Netflix button.
Exactly,
I get it.
exactly.
But it's like, yeah.
Yeah.
So here's what it got me thinking. About 4 or 5 years ago, Hamish Douglas, who was heading up Magellan,
Yep.
came on the podcast and said Netflix was going to be $1 trillion company.
Yes.
Then in about the 12 months after he came on the show, Netflix fell, 70, 80%?
Yeah, it got pumped. Yeah. I wouldn't. Yeah. Yeah.
Netflix is up like 400, 500% from there.
Yeah.
Its market cap is almost $500 billion.
Still a long way to go.
Imagine if you were
Still a long way to go. It would
So-
be wild if it doubled from here. I mean, that's not saying it can't, but like it's like they are absolutely leading, and its competitors have put everything into it. It would have to be crazy for it to double. I would
Yeah.
say. Very much
One other interesting stat that I think is worth noting if you're thinking about the streaming industry. So it's been well documented how Netflix has had so much success creating content from overseas.
Yeah.
Here are the numbers. So Netflix now, they expect 50% of their content spend to come from outside America.
Mm-hmm.
Compare that to Disney, 4% outside of America. So here's the question. If Netflix keeps getting that big and they take up more and more of a share of the spend as a function of them just being bigger and bigger, and they're spending more and more outside of America, does Netflix break Hollywood?
I mean, it could
Yeah.
potentially. Yeah. I don't know.
I don't know.
Like, it's done a very good job, and you see more and more Hollywood stars appearing on Netflix type shows.
Yeah. Well, it's just like, no, I mean Hollywood is like the place where you have to be to make film and TV.
I think that it already has in some way.
Yeah.
Yeah.
So I think we can call the fight. I think Netflix is larger. It can raise prices more. It's growing users faster. It's growing revenue faster. Has a lower churn rate. And the other thing about producing content overseas, it's producing content at a lower cost.
Yes.
So full credit. Still not investing in Netflix. Still streaming still doesn't get me as excited.
No.
But I think we can certainly say that it's won the streaming wars.
Big time. Now let's move on to the working from home debate, Ren. Who's won that? Are we all back in the office?
Well,
or a city's...
It depends.
Or CBD's still facing empty offices?
Yeah, well, they are. So a little while ago on our daily news email, which you can sign up to, link is in the show notes in the YouTube description, we shared a story that included some data from the Australian Property Council, and it had the vacancy rate for Australian office buildings was 14.7% in the 6 months to January, compared to 14.6% in the previous 6 months.
Flat.
That doesn't reconcile with the media narrative around work from home and return to office mandates.
But I think that's the thing. I think it's overblown. I
The
think
return
the
to
whole
office?
like overwhelmingly from what I've seen through all of our mates and just general conversation, it's still very much flexible.
Yeah.
It's kind of like if you're back work from home 5 days a week, it's probably making, or work from office 5 days a week, it's probably making the media because it's so like,
Maybe.
oh my goodness.
Yeah. So the latest story was out of Commonwealth Bank because they've got a return to office mandate, and they're cracking down on coffee badging.
Yeah, I saw
You
this.
heard about this?
Yeah, where you have to be in the office for 4 hours for it to count towards one of your days.
Yeah.
Otherwise, because they were finding people would come on in, swan around, have a coffee, and then hit the road.
Yeah. Make a lot of noise. Everyone knew out there, then go.
Yeah.
It's like 4 hours is still so
It's
generous.
also like, don't they have something to do? Like, what?
No,
are they,
you've worked
if
in a
you're-
big corporate before.
I know. Yeah, well, I'll reserve my comments on what should be done with those people.
So then I just wanted to have a look. So MSCI, the markets data company, they've got Australia's largest office property funds down 27% over the past 2 years. And so that's beyond the initial COVID shock and into the, obviously, like, rates have risen, which is bad for property. But the office sector has underperformed most of the other asset classes. In fact, all of the other property asset classes. And a lot of Australia's largest property owners still not doing well since COVID. Dexus down 42%, Mirvac down 40%, Lendlease down 63%, GPT Group down 27%. One that's bucking the trend, Charter Hall up 21%, but I think that's more because of the mix of property.
Yeah.
Less office, more warehouse and e-commerce.
I was going to say the narrative that seems to be missing from that whole 2 years ago was, what are the weird and wonderful things we're going to do with all of this office space? Turn it into residential or small business or indoor golf centers or whatever it was. Like, so now seems to still be a large chunk of vacant office space in CBDs.
Yeah. I was reading a few articles about people saying, oh, green shoots, it's turning it around. But I feel like there's a lot of people that say that because there's some wish casting going on.
Exactly. Yeah.
Anyway, two sectors I won't be investing in: streaming or office
Nice.
or office property.
Well, if you want to keep up with the rest of the headlines that we think are important from around the world, then make sure you subscribe to our daily newsletter. We send you a summary that you can read in less than 10 minutes to get you up to date and informed with what is happening in the business world. And if that's not enough, or if you prefer listening rather than reading, then we have turned that into a podcast. It's called Headlines by Equity Mates. It's no more than 5 minutes. It's a great way to start your day. So make sure you look at that wherever you are listening to your podcasts.
This is Pimp My Portfolio. Pimp My Portfolio.
We have a listener on the line. We have our expert in the room to pimp the portfolio and give some advice of our listeners. So, Luke, Laretive, welcome.
Bryce, Ren, how are you?
We're
Good,
very
Luke.
well. And then on the line, all the way we have Vincent. Vincent, how are you?
Bom dia. I'm well.
Nice.
Got on
Now,
brand, I like
it's currently about 10 past 1 local time in Brazil, so thank you for staying up all night to do this call with us. We hope Luke's advice is worth it.
Certainly not.
But Ren, take us through Vincent's portfolio.
Okay, so Vincent has a portfolio that I'm very interested to see what Luke has to say. Vincent's biggest holding is Bitcoin, 37% of the portfolio, and then a large holding in an individual stock, New Holdings, NU. And then we've got 5 ETFs, Vanguard, FTSE All World, XUS, NASDAQ 100, S&P 500, FANG Plus, and then back home in Australia, we've got A200. And then finally, 2 individual stocks, Latin Resources and Ioneer. So Luke, we always like to start with a bit of a nickname. What have you got for Vincent?
All right, all the Portuguese and Brazilian speakers, please don't slag me off here. All right, so it's Ofogo de Litio.
Okay.
Do we want the
Which is-
translation?
Does Vincent know what that means?
Probably not, but it's the lithium fire is what Google Translate tells me is what it
The
stands
lithium
The
fire.
lithium fire. Okay.
Close enough.
for.
Close
Yeah, okay,
enough.
cool. So,
Close enough.
How would you say the lithium fire, Vincent?
Oh, yeah, no, that's fine. That's fine. Yeah.
Near enough.
and lithium.
Yeah.
It's about as close as I could get on Google Translate, so I apologise.
So before Luke gets into his thoughts, Vincent, why don't you tell us a little bit about how this portfolio came to be?
I originally started listening to podcasts like this one, and kind of just got interested in different stocks and positions from guests and doing different reading. So it was a few years ago, which was good, but then had a number of individual positions that weren't really kind of doing much, and then kind of focused more and read more and did a bit more research on ETFs, and then kind of sold out a number of small positions, and then just really kind of consolidated that into ETFs. So I wanted to get kind of like a broad exposure to Australia, the world, and obviously the US. And I know that it's probably kind of heavily weighted towards the US, with essentially kind of 3 ETFs somewhat doing the same thing. But with the crypto, originally kind of started out with Bitcoin, and then have just been DCAing into that over the last couple of years, and that's just kind of grown significantly, just obviously with the appreciation of the value of Bitcoin. And that was a position which opened to go just from exposure to markets here and what it was trying to achieve, and have just regularly kind of add into that NU position once funds become available.
Nice.
All right.
I'm going to go quick and try and get because there's actually like a fair bit to cover here.
Sure.
Okay, so like we're going to talk about like core and satellite, which is kind of where he's living in a weird and wonderful kind of way. So Latin Resources, LRS, it's been taken over by Pilbara Minerals now. That's gone. That deal's done. So that's fine. I'm not the biggest fan of that acquisition from a Pilbara Minerals perspective, but you don't care about that, so move on. I think Pilbara Minerals, for the record, will write a check to Wildcat and get that taken over, which we've talked about on this pod just before. Ioneer, it's not looking like a winner in lithium at the moment. If it was me, I'd just take a tax loss, get into another DLE company like Vulcan Energy Resources, which I think is a good buy. Cool. So that's those two done. New holdings. I'm not an expert on this company, but I did, out of intrigue, have a bit of a quick flick. And by a quick flick, I mean it's Monday afternoon, Australia Day, an hour. Luke having a sniff around. So sounds like they're going to pull the trigger on a bit of an international expansion. In my experience from ASX-listed companies in fintech, which is, I was a pretty early shareholder in Zip. I've been around that payment space for a long time. Not dissimilar to kind of where New are sort of living in the digital banking zone. This can be harder and more expensive in practice than stated. So I would be very skeptical on that. And just if you're going to stick with it, have a real close look at that strategy and make sure that you agree with it. It's not cheap, and it is losing sort of momentum across the analyst community. So it has had a few downgrades lately, and a bit of sort of negative on bullish people getting negative, particularly the more bullish people, the more bullish analysts in the market. So you shouldn't have 25% of your money in any single stock unless you're the founder and operator of it. And so I would definitely reduce my exposure. But if you like it, you might know more about it than me. But I certainly, it's not a bad stock for your portfolio. I don't hate it, but I just think you need to be careful.
I didn't know anything about it, but I'm looking at its growth numbers, and
pretty good.
There's some impressive growth there.
So who says emerging markets aren't good places to invest?
Just to be clear, it's listed on the New York Stock Exchange. It's New Holdings. It's a digital banking services provider.
Yep.
Yeah.
Digitizing good little business. Like there's nothing wrong with it at all. It's more just price and weight in your portfolio, and from here, what's it doing, and what's going to be the incremental return from here. Okay, so that's all done. Let's get to your core, because that's what matters. Now, core should be, in this portfolio, you'd think would be your index ETF-y type stuff, plus what I'm going to label as store of wealth allocation. In my view, my opinion, and this is just an opinion, other people have different opinions, store of wealth part of your portfolio should be like 5 or 10% of the portfolio. Now, how you cut that, gold, Bitcoin, I don't know, whatever, cans of milk in your mattress, like I don't care, whatever. That's kind of the right number for the hedge inflation stuff. In my view, many Bitcoin bulls and many Bitcoin, and I'm doing this with the most like sketchy finger italics you can ever do, economists would tell you that you should convert 30, 40, 50, 80% of your fiat currency into Bitcoin because they're going to inflate it away and the blah, blah, blah. I don't agree with that. It's not my view. So, Vincent, you've got to decide what your number is in terms of how much you want to have of your liquid assets storing wealth. But I just ask you to have a think about it. It's not really advice. It's more like a prod, if that makes sense.
Sure. Yeah.
Other than that, I probably would give up on like all these ETFs and just go to a broad-based MSCI all-world type situation. And simplify your life, and then it's going to be easier to sort of delineate, okay, this is my core bit, this is my satellite bit, this is my store of wealth bit. You could probably get there with four holdings, in terms of like a core ETF or two, a couple of stocks that you like, and your coin and your Bitcoin. So just that would be my only feedback. I think the construction's not quite right. I would like to see like maybe 50% of the money invested in that core, and then something else, some other mix of the other stuff. But again, you can leave that. It's up to you. I can't tell you what to do. That's really up to you.
So Vincent, there was a fair bit there. Any questions that come out of that?
Yeah, it's more just kind of like follow-up comment really, because currently what I'm doing now, I'm DCAing about 80% into that kind of core component, with about 20% going into Bitcoin. But it's just that it's run so much over the last, kind of little while, that it's just kind of naturally kind of like letting the runners run kind of thing. So yeah, it's just, I already kind of thought it was simple.
Yeah, the boys know my thoughts on, letting the winners run and cutting the losers for like arbitrarily like that. I think that's not good portfolio strategy and doesn't work out in the long run generally. I think think about rebalancing at regular intervals or at certain thresholds. So let's pretend 35% was your number for Bitcoin in your portfolio as your top end allocation. You didn't want any more money invested in that. When it gets to 37 like it is now, you'd be putting like a watch on it and being like, okay, once it gets to, and maybe 5% tolerance, and then 40, you would have to sell it back down to 35 as part of your rules.
Yeah,
Does that make sense? So that way you'd always, and you would reinvest that money to the other part of the portfolio that wasn't doing so well, such that you were hopefully like, buying avocados in summer when they're on sale type vibes.
So there are two ways to approach that rebalance. One is you have optimal portfolio weights, and then when something gets out of weight, that's the trigger to rebalance. The other one you said was periodically checking and rebalancing.
Yeah, suboptimal. I reckon the threshold one's way better.
Threshold's better?
Yeah, because it's more like we're rebalancing to get the weights right. So we're basing our decision on the weights rather than just time, some arbitrary time that we label, how many revolutions around the sun or whatever.
Yeah. Okay. Yeah. Nice.
And Vincent, are you DCAing into all the ETFs every whatever period it is?
Yes. Yeah. Every single one.
Because there's probably a huge overlap between NASDAQ 100, S&P 500, and FANG Plus. So I think what Luke was saying there,
absolutely.
Yeah, trying to consolidate at least of those into a single investment.
Particularly if your view is that, market cap weighted index ETFs are the best way to allocate capital that you can do. In that case, then actually do it is probably what I would say, is because even though you are dollar cost averaging in, you're not following the sort of like the base core principle of adding the most money to the biggest company and the second most money to the second biggest company for your core, if that makes sense.
Yeah, sure. Yeah, gotcha. I was going to ask, so just in relation to, so you're saying from a general point of view, there would be some merit in kind of consolidating down the ETFs and going more of a potentially like a global approach. Is there anything kind of hanging around the edges, potentially like in the small cap space or anything like that? Anything which is kind of glaringly obvious?
Is there a better way to build your portfolio than just align it with the MSCI All World Index? Yes, is the answer. Do you necessarily want to add that level of complexity to grab the incremental returns? Maybe, right? Depends who you are, what you want to do. For the purposes of this conversation, I think that's going to tick off a lot of boxes for you. But yes, do you is there value in allocating more money outside the US right now? Yes. Is there value in buying smaller companies over large companies right now? Yes. Can you do those things with an ETF effectively? I would argue no. So, it's going to require you researching managers, understanding managers, thinking about your portfolio a little bit more, thinking about, how much money this actually is and how much these incremental tweaks are going to actually mean to you. Because if it's going to be $2,000 extra money, well, I'd probably just argue it's not worth the hassle. If it's going to be $2 million extra money, you might want to argue. Do you understand what I'm saying? The economies of scale start to kind of play out here sometimes too.
Yeah.
And I think,
definitely.
for the average person with $100,000 or $200,000 in the market, like it's not that much of a big deal. But if you've got 10 or 20 million bucks or even $2 million or you're near retirement age and blah, 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 then stuff starts to change.
So Vincent, I think the summary is like the building blocks are there, the thinking looks okay. There's some tweaks you can make. Think about the allocation to Bitcoin and your optimal portfolio weightings. The 25% to one's individual stock is, again, think about the weightings there. And then think about the construction of the core, but, you're taking steps in the right direction and keep going. And once you get to that $2 million mark, come back on and Luke can talk about the other tilts you can make to the portfolio.
It's not about the $2 million mark.
Absolutely, yeah.
But it is about doing things, getting the most out of your hard work that you're doing, which is saving money and putting it in the market every month or every week or whatever it is. So congratulations on that. You're doing a really good job. It's wicked that you've got started investing like this and you made a few dollars and, it's all going well for you. Congratulations. And I do think, you've got the hard bit you're doing. So just do the easy bit properly.
Nice one.
Nice.
Well,
Great
Vincent, thank you for joining us. Thank you for staying up late, and we'll let you go to bed. But no, we appreciate it.
Appreciate it. Thanks.
All right,
Ciao.
bye-bye. And a reminder, if you would like to speak to Luke regarding your portfolio or any of our other advisors, you can head to equitymates.com/advice and there will be a form to fill in there. But Luke, as always, absolute pleasure.
Pleasure, boys. Always enjoyable.
Welcome back to Equity Mates. I'm excited for this segment. I'm always excited on this show. But Bryce, you have had a couple of companies on your watch list that you haven't pulled the trigger on because you've been getting your statement of advice and you've been figuring out debt recycling, blah, blah, blah.
Yeah.
I've heard it all before. But now you've got your advice and you're building a watch list of stocks that you're going to do further research on or that you might be buying once you do all the strategy implementation.
Yeah, well, it still could take a while, but yes.
Yeah. So you wanted to talk about a couple of the stocks that are on your watch list.
Yeah, one stock that I'm just so bullish on the thematic that I've had a decent look at it, and it's one that I'm really looking forward to putting into my portfolio, and that is Eli Lilly.
Okay.
Not a new stock.
Not
new, but like to just wind it back a bit, the last sort of 2 years, maybe from the start of 2023 to mid 2024 was like GLP-1 boomtown. Novo Nordisk became the most valuable company in Europe.
Yep. In Denmark.
In Denmark.
Yeah.
Perhaps coincidentally, because it didn't actually innovate on Ozempic. It already had it in its stable, and it just came out that it was awesome at weight loss. But anyway, that's something I'll get to in a second.
It created the category.
But so, for example, like it came out that it was really good at weight loss, but it already had the drug. Eli Lilly didn't have Mounjaro or anything like that, so it's actually innovated in.
That's not true.
Yes,
bro.
it is.
It's not like they separately came to the conclusion. Novo Nordisk developed this for diabetes.
Yeah.
Then they realized the associated weight loss benefits.
Yes.
And then Eli Lilly capitalized on that research and produced a competitive
That's
drug.
exactly what I just said.
That's not innovating.
Yes, it is.
That's them.
Because now this is going down a rabbit hole fast. Because Ozempic has tried. Ozempic. What are they called? Novo have tried subsequently to actually create a weight loss for GLP-1, not diabetes, and it's failed.
I hate this argument. Did you listen to Aswath Damodaran? Is this where this has come from?
No, I read this.
Oh, okay.
Has he said something
He
similar?
said something similar, and it got me so annoyed. He was like...
Well, then it's maybe come from that.
He was like, they got lucky. You know, they created this drug, and they didn't realize that it was a weight loss drug. And if they don't continue to innovate, then they'll just become a sleepy Danish diabetes company again.
Thank you.
Is that what you're saying?
No, that's not the thesis.
The thing that annoyed me so much is that is the history of drug development. And there is no more famous example than one of the best-selling drugs of all time. The little blue pill, whose name has escaped me just as I get to my point.
Viagra.
Viagra.
Yeah.
Pfizer was developing or trying to figure out heart medication.
Yeah.
And they realized that this drug constricted blood vessels and had an unintended side effect.
Yeah.
Fast forward however many years, and it's one of the best selling drugs of all time.
Yeah.
No one's saying, Pfizer doesn't get credit for what they developed, blah, blah, blah. Pfizer can't make a good business out of something. People luck into good businesses or medical discoveries
so they've lucked
all the
into
time.
it, but it's becoming clear that it's not the best. Viagra was the best. It still is the best.
Well, have you seen their phase 1 trials for their latest?
Yeah,
Novo?
it's failing.
No,
Yes,
was
it is.
doubly as effective as Ozempic.
Yeah, but I still think it hasn't. Their latest one apparently was a massive fail.
Yeah, I think we might be talking about different trials.
Oh, okay.
Yeah.
Well, I haven't seen. Anyway, that's not my theory. The point was, I think.
The point is, Eli Lilly didn't sit in a lab and come up with this idea.
No, I know. I'm not saying that.
Okay.
I'm not saying that at all. I'm saying they've seen how successful Novo was and went out and created a better drug.
Copied, yeah.
Yeah. It doesn't matter if they copied them.
Yeah, okay.
Yeah. Anyway, the point was, it went gangbusters, but then we had massive supply issues.
Yeah.
Both of them couldn't keep up with the demand, and then it was put onto an emergency list by the FDA or whatever it was, and a bunch of compound companies came on and started flooding the market with cheaper alternatives. That has subsequently now eased, and both Novo Nordisk and Eli Lilly have been investing billions of dollars into the manufacture and supply of GLP-1. So I just want to remind people of why I think this is just such a long-term opportunity here. GLP-1, yes, was originally for diabetes management, but it's come out that it's weight loss. It has reduces major adverse cardiovascular events. It reduces blood pressure. It improves lipid profiles. It lowers risk of dementia and Alzheimer's. Reduction in seizures and psychotic disorders, reduced substance use disorders, lower risk of suicide, you name it. It has been proven that this is one of those drugs that, if it can get to the masses, is going to be wild. So no one's denying the health benefit. Where I think Eli Lilly has got in front is that they have a better drug, or two better drugs. Mounjaro and Zepbound are their two drugs. In clinical trials, they have achieved up to 25.5% weight loss over 72 weeks, compared to Wegovy and Ozempic, which is about 15% over the same period of time. So better drug. They also have better supply chain at the moment. They've invested more into their supply chains, and we're now starting to see this flow through. To be fair, Novo had a pretty good result recently, where they've said the demand is back. They can now start to match the supply. And what we're seeing is all of these pharmacies that were creating compound drugs are now, not so much allowed to do it, because once it leaves the emergency list, you're actually not allowed to compound as much, or there's more restrictions around it. So we have two main players. But Eli Lilly is fast becoming the major competitor in this space, or the major leader in this space.
So, you keep going, and then I want to give my counterpoint.
So let's just bring it to real numbers. So in the first quarter of 2025, they took top spot in revenue growth among biopharma companies, with 28% revenue year on year. They project that Mounjaro could generate sales of $34 billion by 2029, potentially overtaking Ozempic as the top manager or the top drug for diabetes treatment. And it has about just shy of a 50% market share, or expected to get there. It is expensive, trading on a 75 PE, but I think now that the craziness has sort of quietened down, Eli Lilly has had a great start to the year. Novo has come off its high. The studies for GLP-1 just keep getting better and better. Governments are now starting to push for it to be subsidized. I think here in Australia, they're trying to push to get it onto the pharmaceutical benefits scheme.
No, the drug companies want to get it on the pharmaceutical benefits scheme. Yeah.
Great.
Oh yeah, I'm not complaining.
Yeah. And as I said, supply side is drastically improving. And I can only imagine that if they get the supply side right over the next year or so, we're going to start seeing those pretty decent revenue growth numbers start coming back in as demand matches, or as supply matches demand. So I was going to back both horses, but looking into it, I just feel that Eli Lilly is, not to mention all the other stuff that it's doing, but I think Eli Lilly is the leader in this GLP-1 space. Nice. So that's a convoluted way of saying I'm going to put some money in it.
Love it. So this was going to be a watch list segment, but I think let's just debate GLP-1 for a second.
Sure, yeah.
So I love it. And Eli Lilly, I'm pretty bullish on as well. Question around valuation. 2 points that I guess I want you to consider. First of all, if the thesis is purely GLP-1 drugs.
It's not purely, but that's,
I mean, you're not buying Eli Lilly for its oncology revenue.
No.
Yeah.
For me, that's like a nice cherry on top.
Yeah. So the reason that, one reason you might consider Novo over Eli, and I'm not pushing you to do that, but most recent quarter, new products, which is what Zepbound and Mounjaro still sit in for Eli Lilly, that was 5.6 billion in revenue. Total revenue for the quarter was 13.5 billion. So even if those 2 GLP-1 drugs are that full new products revenue, which they're not, but they'll be the lion's share, still less than half of overall revenue.
Yeah.
So that's one thing to consider.
That's fine.
Okay.
Because imagine when that grows to 75% of revenue.
Well, yeah, it's just saying like, it's not.
I'm not saying this is pure play GLP-1 investment.
Yeah,
for me.
well, whereas Novo basically is.
It is. Yeah.
So, I mean, that was your full run in.
I know, but I think because I just think like this is where it is now, but like,
where will it be? Yeah.
Where will it be? Yeah.
The second thing, so I had a bit of a look at we were talking about different drugs. So the Novo drug that they're defending and hasn't done as well is called CagriSema. The drug that I was talking about is its just latest version of the GLP-1s, which is amycretin. So stage 1 trials of amycretin, you mentioned that you said that Eli Lilly's was the best on the market. Zepbound achieved over 72 weeks, 22.5% weight loss.
Yes.
How's this for amycretin from Novo Nordisk? 22% weight loss in 36 weeks.
Half the time.
What
would you rather, half the time or more weight loss? Half a percent.
So I think, the point is just that they're both going to keep getting better.
Yeah, and to be fair, that's why I said at the end, I genuinely have thought about buying both. Like I know you own Novo. I did, but in this whole advice thing, I got rid of it. But it's kind of like back both horses until it becomes clear who is the winner. Because I think overall, as I said, that the whole point of this is that like I'm thinking decade-long thematics here, and if GLP-1 does everything that it says and it can become accessible to everyday people, like it is just going to explode.
Yeah. To be honest, my thesis on Novo is softening a little bit. Like the reason I bought it was GLP-1's changing the world, so effective, weight loss drugs that actually work, all these associated benefits. And Novo has built this incredible brand around Ozempic to the point where like people, like when we would write articles, it would have to be like, semaglutide drugs like Ozempic or GLP-1 drugs like Ozempic. Like Ozempic was the name that everyone knew. And particularly in the States, its brand recognition was crazy. They had that TV campaign. I'm not going to sing it, but the Ozempic jingle was like imprinted on people's mind. And for me, it was like they're first to market. It works. They've got like an incredible brand name. I reckon what's happened is they've kind of fumbled the bag on the brand name because Ozempic is just for diabetes, and then they've launched Wegovy, which is for weight loss, which is now the one that's growing faster and getting more investment. But that then dilutes the brand equity that they've built in Ozempic. And then it also opens the door for, there's a Wegovy and Ozempic, and then there's Zepbound, and there's Mounjaro, and there's all of them where it's like, at first the positioning was there's Ozempic and the rest.
Yeah.
And so, for me, it's going to be, it's just, I think they're all going to win, to be honest.
We'll see.
Yeah.
Yeah.
But like where, Eli Lilly's trading at 75 times PE. Novo's not cheap.
Novo's not cheap, but I reckon they could close that gap pretty quickly. Like if they, it just depends how fast they can get it to market and how quickly this supply issue can get solved. And then the demand's there. Like even though it's still like, you got to be in the top 1% of society to be able to afford it, or on, like I think in America, Biden has subsidized it for a few million people.
Yeah.
But it's still like as percentage of like proportion of population,
Yeah, well,
It's
70% of America is overweight.
Yeah.
40% of America is obese.
Get that going.
Yeah.
It's wild.
The reinvestment runway is long.
Yeah, I can just,
And it's a drug that, sadly, people won't be able to get off. Like,
yeah.
there are stories of people
That's classic
getting
Big
off
Pharma.
it, and then putting the weight back on.
Yeah.
So, anyway, this isn't a buy, hold, or sell.
No, but I just love the thematic. I love thinking about it.
Yeah. Any other names on your watch list?
There is one more on the watch list, less bullish, but very much watching, and it's Costco.
Okay.
Yeah. So firstly, this came up because I was just, it started the year strong. It's up 14%, 44% for the last year, 240% for the last 5 years. I also love retail. So what I like about Costco, or what sort of separates it from its competitors, is its membership structure. So pretty good recurring revenue. You have to obviously pay to be a member of Costco, for those that are unaware. In Q2, it generated 1.1 billion in sales, but it has a 90% renewal rate on its membership. That tells me that this business is providing heaps of value.
That's a higher churn rate than all of the streaming services.
Yes, but it's a retail shop. It's like, why? Like, people are paying to be a member of something that they could go to for free.
Yeah.
Do you know what I mean? Like, they could go to Walmart and effectively get pretty similar.
No.
Yeah,
That's
okay, sure.
blasphemous.
You're not gonna.
No, like the quality of Costco and Kirkland home brand and the prices you get.
But what I mean is the substitution here is like, it's amazing that the renewal rate is 90%.
I know what you're saying. You're just going to get attacked by people that love Costco if you say it's basically
I love
the
Costco.
same.
I love Costco. You get me. It's had very consistent revenue growth, CAGR of 12% over the last sort of 5 years or so. But what I like about it is that there is massive room for expansion of their e-commerce business that they are really pushing at the moment. And this surprises me.
People aren't buying pallets of toilet paper e-commerce.
This is what I thought. And I was like, this doesn't make sense. But it's the fastest growing part of their business at the moment. And it's wild how far behind it seems. Like, yeah, maybe people are ordering 2 kilo jars of olives. Yeah, they are, because they put numbers around how many drivers they've got out there and whatnot. It's wild. But their e-commerce business sales have increased 13% year on year, and that compares to 5.5% for their same store sales. So much faster growth. Online sales, though, is only about a 6 or 7% contribution to total revenue. You compare that to the likes of Walmart, which is 14%. Woolies here in Australia, it's 12%. So significant runway there if it can get to that sort of penetration. And obviously the margins there, and we know what online sales have done to both Walmart and Woolworths from a shareholder point of view. So something that I'm watching, 42 million downloads of their app. It is expensive though, trading at 61 times PE, but it has always been a more expensive retailer.
E-commerce grocery margins aren't better than store grocery margins.
That's true.
Yeah, because they still move through the supply chain.
That's
and
true.
Yeah.
That's true.
You just said that as
throwaway.
Yeah. It's been a while since you've been in retail, obviously.
But yeah, look, I'm watching it.
Yeah. One fun fact about Costco that I read and didn't fact check, so take it with a grain of salt. You know how the way that these retailers do own brand is they don't like build their own manufacturing plants. They go to a supplier and say, here's a contract to make our own brand. Coles, Woolies, Walmart, Costco all do the same thing. Apparently Costco have a rule that the Kirkland brand product has to be better in one specific way. Like, there's a list and they have to choose one. It has to be better than the branded product. So like if you go to SPC and say, we want to do Kirkland branded tin fruit.
Yeah.
There's like a criteria, and it has to be better than the SPC brand in one of those ways.
Oh, sorry. One of the characteristics of the product has to be better than the branded, so that they can make a marketing claim that
I think
lower sugar or...
No, I think it's just like they drive quality so hard in their own brand. And then I think that the trade-off is the supplier does it because then they know they get that volume, but they also get shelf space for their branded product.
Yeah.
But like that's part of the reason why people love the Kirkland brand.
Nice. good quality.
Anyway,
I
do your own
believe that. I
research.
believe that. But like, yeah, so it's one that I'm watching. But to be fair, like I said, it started the year strong. Walmart has equally started up 14%, I think, as well. So yeah, something's going on over there.
You just got to be invested.
I know.
That's, you know.
How's Woolworths started? Probably not that strong. But anyway, that's one that just came across the desk. I could be keeping an eye on it. Woolworths is down 1% for the year. There you go.
Just got to invest globally. All right, well, that'll do us for today. Big episode, a lot of stocks discussed. Make sure you're subscribed wherever you're watching or you're listening so you don't miss an episode. But, Bryce, that'll do us for today.
Sounds good.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.